Thank you very much for letting me present my work. This is a joint paper with Evrim Akdoğu. And this is a very, very early stage of this work, so I'd appreciate comments and feedback. So as we all know, the structure of restrictive covenants is one of the key components of firm financial policy, right? So the agency theoretic view of covenants suggests that covenants reduce the cost of debt by mitigating the conflicts of interest between bondholders and stockholders. In the absence of such contracting mechanisms, managers who act on behalf of shareholders will engage in activities that will benefit shareholders at the expense of bondholders. And hence, bondholders will anticipate these costs and price the debt accordingly ex ante, leading to a lower value of the outstanding debt and also leading to lower overall value of the firm. So this is, of course, a serious agency problem, and covenants come into play here. They alleviate these agency problems, and the bright side is that basically they reduce the cost of debt, right? So this is the benefit, the bright side of covenants. Of course, covenants also come with costs. So the cost is that basically they restrict the firm's financial and investment policy, right? So the reduced flexibility over the firm's financing and investment policies is the cost of covenants. So existing research on covenants usually mostly focus on the determinants of covenants, or like the covenant violations and the effect of covenant violations on firm financial policy and investment policy. But relatively less attention has been paid to the evolution of covenants over time. So basically, this is what we're trying to do in this paper. We're trying to study basically the trends in bond covenants for the US firms for the period 1980 to 2012. And to do so, we use the covenant index created by Bletking and Mauer in their 2007 JF paper. And as in Bletking and Mauer, we basically use the covenant information in merge and FASD data. There are over 50 covenant information about 50 covenants, and we aggregate these covenants over the firm's bonds, and we arrive at a firm level covenant index. And then we track the changes in this covenant index over time, over our study period. Okay, so what do we find? Here are our main findings. First, we find that there is basically a secular increase in the use of bond covenants between 1980 and 2012, right? So if you look at a typical firm in 1980, a typical firm will use one covenant category on the average in 1980. Whereas if you come to 2012, you'll see that a typical firm will use about 6 covenant categories in 2012. So there seems to be some sort of increase in the use of bond covenants. We then try to explain the causes of this increase. So of course, we look at whether the changing firm characteristics, right, the changing composition of the sample is driving this increase in covenants. So we examine the demand side factors, and we find that the demand side factors or the changing firm characteristics can only partially explain the increasing trends in covenants, and we cannot explain more than 30 to 40% of the trends using demand side factors. So this turns our attention to supply side effects. So we explore whether the supply side factors can also play a role in the evolution of covenant structure. And we do find evidence to suggest that the supply side factors indeed play also a role in the covenant trends as well. I mean, we examine new bond issues and track their covenant patterns, and we find similar patterns in the new bonds. And perhaps more importantly, we try to explore the implications of this increase in covenants. I mean, so far, we just look at the effect of this increase on credit spreads. Of course, it would be nice to look at on the dark sides as well. On the credit spreads, we find that the increase in covenant trends leads to a lower cost of debt financing for firms. So they lead to a lower level of credit spreads for firms. Okay, Let me very briefly talk about the background here. The literature focusing on the determinants of covenants usually provides findings consistent with the agency theory of covenants. So, you would expect the riskier firms, to use more covenants because these are the set of firms that are more prone to stockholder-bondholder conflicts. And literature basically, provides, results confirming this prediction. We see that smaller firms or higher levered firms use more covenants. Firms with a higher probability of bankruptcy use more covenants. Firms with lower ratings use more covenants, right? So basically, we can say that roughly, broadly speaking, the evidence is consistent with the agency theoretic view of covenants. On the price effects also, we see usually consistent results of the effect of covenants on cost of debt. And the papers such as Bradley and Roberts, Reisel and Goyal find that covenants do reduce the cost of debt. Okay, let me try to get into data here a little bit more in detail. So basically, we use the merge and FASD database as the previous study. And FASD database provides bond level information and provides the covenant information over 50 covenant categories. But of course, there are multiple covenants serving the same purpose, right? I mean, there are 3 or 4 covenants. They are, trying to test for the overall leverage of the firm, or there are several covenants which are just, trying to limit the dividend payouts. So basically, it makes more sense to, group those covenants under major categories if one were to create a, firm level index. And so we also, as in Blitking and Meyer, create 15 covenant categories and 15 indicator variables. And for a firm, we assign a level of 1 to that indicator variable if any of the firm's bonds have a covenant belonging to that category. So in that sense, we aggregate the covenants over the firm's bonds, right? So this, of course, this method presumes that a covenant attached to one bond also provides protection for the remaining bonds of the firm. And it sounds like a reasonable assumption because assuming that a covenant preventing a firm from distributing dividends to its shareholders, obviously if it exists in one bond, it's going to protect the other bondholders as well. And in the end, basically, we eliminate the financial firms, the regulated firms, and we match the data to Compustat, and we end up with about over 15,000 firm year observations that we can examine covenant trends. Okay, let me begin by documenting the trends in our covenant index, right? In the covenant index. So this figure plots the mean and the median covenant index throughout our study period. So as you can see, basically there's an apparent increase in the use of covenants. And around 1980, when we start a sample, an average firm uses about 1 covenant category out of 15. So this index can take values between 0 and 15. And around 1980, the index level is mean index level is 1. And when we come to 1999 or 2000, basically we see that the index reaches about 6 covenants category, right? So there's a clear increase. After 1999-2000, there's a moderate drop in the use of covenants, and the index ends the sample period around 5.5 covenants level. So the median index also providing similar trends, right? So when we look at this sort of trend, and when we take into account the other papers studying trend in other variables, right, such as the Bates-Kalish-Tools paper studying the trends in the cash holdings of U.S. corporations, or if you think about from a French paper, the disappearing dividends puzzle, right? In these papers, basically the new listing firms, right, the small new listing firms entering the sample, right, are mainly responsible, or a big part of the cause of the increasing trends, or the in the cash holdings or in the disappearing dividends puzzle, right? So of course, the first usual suspect that we look at here is, are these new listing firms driving our results as well? And the answer is no. So I don't have it here, but basically we plot the covenant index for different IPO cohorts, and we find pretty consistent results of increase basically in different IPO cohorts. In the 1990s IPO cohort, there is some, sort of additional, like higher level, which might correspond to the technology firms listing, during that period, but they're not strong enough to basically drive the old trend, and the other IPO cohorts follow similar patterns as well. So we also, look at other subsamples since, the papers, as I said, the cash paper and the dividend paper are providing this sort of trends as well. We, group firms based on size, based on, dividend payer status, based on cash holdings, and basically we find like a persistent increase in different subsamples in the covenant index. One difference here is if you look at firms, in terms of whether they are speculative grade or investment grade, speculative grade firms exhibit some, more serious drop here after the 1990s, but overall, basically, together with the investment grade firms, the patterns are very similar. Okay. So, of course, if the firms in our sample are getting riskier over time, or if the composition of the firms is changing over time so that we have more smaller firms, more riskier firms, more high-levered firms in our sample, and they are using more covenants, so that would be not surprising, right? So basically, the increase in covenant trends can be driven by changing firm characteristics, right? Or it can be driven by a change in the composition of firms, or it can be driven by the changing slope coefficients, basically, of these variables. So in this part of the analysis, we try to formally examine whether the changing firm characteristics can explain the increasing dividend trends. So to do so, we model the covenants as a function of certain variables that is motivated by the agency theory of covenants, right? So we model covenants as a function of leverage, maturity, size, volatility, market-to-book R&D tangibility, convertible dummy, and basically, we try to see what part of the trend these variables can explain, right? In addition, in the model, we include decade dummy indicator variables, and these decade dummy indicator variables are supposed to capture any sort of trend that cannot be explained by these changing firm characteristics. And if you look at the results, basically the coefficients on the control variables are largely consistent with expectations, right? We see that higher levered firms have more covenants. As short-term debt and covenants are substitutes in mitigating stockholder-bondholder conflicts, we see that there's a negative sign on the proportion of short-term debt. Smaller firms use more covenants, right? High R&D firms, which are usually high-growth firms, do not have more covenants, which is reasonable because perhaps for these high-growth firms, it is very costly to restrict their investment and financing activities, right? Also, we see that the convertible debt dummy, which basically is an indicator variable that takes one if a firm has any sort of convertible debt issue, any convertible debt outstanding at that particular year. And that's also significantly negative, which is also consistent with literature, particularly Kahan and Yarmak, which suggests that basically the conversion feature is perhaps a more cost-effective way of dealing with this stockholder-bondholder conflicts for certain firms, particularly high-growth firms. So, okay, the control variables are largely consistent with expectations. So, of course, our main focus on this table is the pattern of year indicator, decade indicator variables, right? So as we can see, the decade indicator variables are all positive and significant at the 1% level in all specifications. And more importantly, they exhibit a monotonically increasing pattern, right? So if you look at column 1, you can see that in the 90s, firms used 2.5 more covenants compared to the left-out category in 1980s, right? And in the 2000s, this number is even more than 3 covenants, firms utilized compared to 80s. And in 2010s, even more, 331, compared to, again, 80s, the left-out category. So we try, a variety of specifications. We, control for industry fixed effects, rating fixed effects. We also control for firm fixed effects to see whether the changing composition of firms are driving these, trends. And basically, the results are quite consistent, with these specifications. We do not see, substantial differences in the results. So basically, this is telling us that, decade indicator variables capturing an increasing trend in covenants beyond what can be explained by changing firm characteristics. In the last 2 columns, we replaced the decade indicator variables with 2 trend variables, basically to, get an idea of the pace of increase in the covenants per year, right? And we see that with the industry fixed effects, specification, and even with the firm fixed effects specification, the covenants increased about like 0.11 covenants per year, right? Even after controlling for the demand side factors that we consider in this analysis. So this basically tells us that, something else is also going on perhaps beyond the demand side factors. I mean, of course, you can argue that, putting just decade indicator dummies is simplistic. What if the slope coefficients are also changing over time, right? So this is a concern, and we address that concern. We interact the decade indicator variables with, the control variables, and then look at the, pattern of decade indicator variables, and we see similar results. Also, we do another approach. We just estimate the covenant model using 1980s, and then we predict the covenants for the remaining part of the sample. And then we see that the predicted covenants using those 80s coefficients consistently fall short of the actual covenants in the later periods. So basically, the model in 80s is predicting smaller covenants for the following decades. So from this analysis, basically, we conclude that demand side factors can explain only partially the increasing covenants. And in the row picture that I showed you, the pace of increase per year was about 0.17 covenants per year. And here, in the time trends, we can see that it's like roughly 0.11. So from there, we can roughly calculate that the demand side factors can explain 30 to 40% of the increase in covenant trends. Okay, so another criticism can be that, what if you have a missing variable in your analysis? Of course, this is a general concern for, all studies. But to alleviate those concerns, we basically look at, several additional variables that are potentially related to covenant use. We try idiosyncratic volatility, dividend payer, cash balances, capex, interest coverage, firm age, GIM index, EBITDA margin, and basically, overall, the results seem to be, not sensitive to inclusion of these variables. So our results are, we do not observe substantial changes, basically, in the pattern of decade indicator variables. There is some, of course, differentiation, but, broadly speaking, the patterns are similar. Another thing that we do is basically, control for macroeconomic factors, right? If there's a trend in the macroeconomic variables, it could be that our index is just following, those factors. So we try several macro variables as well, and again, basically, inclusion of these variables in the model does not cause a substantial change in the estimation of, in the coefficients of decade indicator variables. Okay, so the firm level covenant index aggregates the covenants of a firm over its bonds, and it is reflective of all the past outstanding debt issuances, right? So suppose as a firm, I issued a bond 5 years ago, it had a set of covenants, and it had a 10-year maturity, so today that bond is still active, and those covenants are still basically protecting me, right? So, and they are part of my firm level index, right? So, but that decision is in the past, 5 years ago. It's not a very recent decision. So in that sense, it might be useful also to look to take an incremental approach and to examine the trends, in covenants for new bond issues, right? For just new issues. So in this part of the analysis, we do that. Basically, here again, we create a bond covenant index. We have the same 15 indicator variables. Now, we don't aggregate them, of course. We just sum them up for a particular bond issue, right? And we plot the mean, covenant index for our new bond issues in this picture. As you can see, broadly speaking, there's a increase in bond covenants for new bonds issue sample as well. However, there are some differences as well compared to the firm year sample. We see some sort of cyclicality, right? Of course, it's not as smooth. And particularly 1990s, we see, the covenants peak, right? 5 minutes? OK. Wow, OK. I need to go a bit fast. Well, I mean, we have some explanations for this peak, but let me just, in the interest of time, continue. Basically, here, broadly speaking, we say that new bonds exhibit increasing trends as well, although with some cyclicalities. So, but that is specific to the straight bonds. When we look at convertible bonds, there's not much of a trend that we can observe. And we repeat the analysis for the new bonds to see whether the changing firm characteristics are driving the results. But again, we get significant and positive decade indicator variables. And the variables are not able to explain that. But one difference here is that 1990s dummy is the peak number here. So we do not have a monotonic increase in the decade indicator variables, but a peak in the 90s. OK, so let me talk about the supply side test a bit. Right, so we tried basically, we saw that basically the demand side factors can only partially explain the increase in covenant trends, right? So this turns our attention to the supply side factors, right? This inability of the demand side factors to explain the covenant trends fully turns our attention to supply side tests. So the classical assumption in corporate finance is that a firm's leverage is completely a function of a firm's demand for debt, right? And there's no role for the supply side role. And the supply of capital is infinitely elastic at the correct price, and cost of capital depends only on the risk of the firm, right? But there's a recent branch of literature which is challenging this view and emphasizing the role of supply of capital in the firm financial policy, right? So Folkander and Peterson showing that the source of basically financing can explain, make a huge difference in the leverage level of the firms, right? Leary, Sophie, Lemon Roberts. Recently, Murphin is basically providing, the role of supply side factors in the covenant strictens in the bank loans. And Custodio et al., Eris and JFE paper, is pointing to the role of supply-side factors in the shortening the maturity trends of US firms, right? So basically, we examined the possibility that supply-side factors might be also playing a role in the evolution of covenants, right? And to do so, we studied the trends in covenants around exogenous events that affect credit market conditions. OK, so first, we utilized the collapse of Drexel-Burnham-Lambert in 1989 and the subsequent regulatory changes as an exogenous shock to the supply of speculative grade credit. So here, we employ a difference in difference specification, and where the treatment group is the speculative grade firms and the control group is the investment grade firms. And because the credit conditions deteriorate for speculative grade debt, we expect to find that the speculative grade firms increase their covenant use relative to investment grade firms. So in our specification, of course, we have the post-89 speculative grade dummy and the interaction between speculative grade dummy and the post-89 dummy. And this is and additional controls. And our focus is on the here interaction variable, of course, to see basically whether the speculative grade firms indeed increase their level of covenants compared to investment grade firms. And that's what indeed we find. We find that our interaction variable is significant and positive at 1% level in all specifications, suggesting that the speculative grade firms, right, increase their use of covenants compared to investment grade firms around this event. And perhaps the contraction in the investor demand for the speculative grade debt at this time point forced the speculative grade firms to bolster their securities with additional covenants to make them attractive to the suppliers of capital, right? So that's what we conclude from here, and we think of this as evidence of the role of supply side factors in the covenant trends. Okay, so we do look at other sort of exogenous events as well. It's over, fine, okay. Just let me conclude with like a minute. Finally, we look at the credit spreads. Okay, past literature already provides that covenants reduce credit spreads, so we just repeat it here and find the negative coefficient. But what we are more interested in is actually whether the increasing trends in covenants actually indeed help reduce the credit spreads. So to do that, we decompose the bond covenant index into its model predicted component and the unexplained residual component. Right, so we predict covenants using we estimate the model using 80s, predict for the future periods using these coefficients from the 80s, and the predicted one is the explained component, and the actual minus predicted covenant is the unexplained residual trend. And we regress credit spreads on both of these variables to see basically the unexplained component, perhaps driven by supply side factors or something else that we don't consider, is also reducing credit spreads, and we do find that is the case here. Okay. So let me conclude. There's an increasing trend in the use of bond covenants for US corporations between 80 and 2012. And demand and supply side factors both seem to play a role in explaining this trend. And the increase in covenant trends appears to lead to a decrease in the cost of debt financing for firms. Thank you. Okay.